Thank you for joining us at Barvin's 2022 Investor Day. Barvin is a vertically integrated multifamily company with a 13-year track record of success. My name is Kate Kelm, and I am Barvin's Director of Investor Relations. It is a privilege to work with the team and advisory board that will be presenting today. I also find it fulfilling to work with you, the investor, helping to generate returns and build long-lasting communities. Before we begin, I would like to remind everyone to view the cautionary material on slide 2 regarding forward-looking statements. We have a wide-ranging itinerary for you today, beginning with commentary from our CEO, Eric Barvin. Eric will take you through our outlook on the multifamily industry. Randy L., our COO, will then provide an update on operations and performance at Barvin. Next, we will feature a panel with our world-class advisory board as they discuss their views on the multifamily industry. Finally, closing out our event will be a live Q&A session featuring our CEO and COO, as well as our SVP of Operations, Mark Foraker, and our VP of Development, Derek LaRoe. Please wait until the end of today's presentation to submit questions. Starting with a single complex in 2009 and then methodically expanding into Dallas, San Antonio, Atlanta, Fort Worth, and Austin, Barvin has established a strong operational and investment presence in some of the most attractive multifamily markets in the U.S. Looking into the future, we anticipate our expansion to include 2 new target markets, Phoenix and Denver. Barvin sees itself as more than an apartment investment company. We create communities that withstand the test of time. We see each project as an investment, not just in the property itself, but in our partners and our employees. We apply this approach into outreach programs as well. Activities like blood drives, charity marathons, or participation in organizations like Habitat for Humanity and Rebuilding Together. Barvin is committed to our values of going above and beyond for all of our stakeholders. We are grateful for the trust that our partners have in our company. We have an extraordinary team of commercial real estate professionals. Our team is cycle-tested and proven with over 150 years of combined experience, including track records of prospering throughout various real estate cycles. Our leadership has inspired over 700 partners to entrust Barvin with approximately $350 million in equity invested. It has allowed us to expand our business to include over $1 billion in assets under management and over 6,500 units of multifamily housing acquired and developed across nearly 20 properties. I would again like to thank our esteemed advisory board for providing guidance to us through the years. In the next 2 sections of the presentation, we will be addressing our multifamily outlook with a focus on robust fundamentals, interest rates, housing undersupply, multifamily historical returns, and future opportunities. In the second section, our COO, Randy L., will walk us through Barvin's transition to in-house property management, as well as our portfolio performance and positioning, including the planned sale of some of our long-held properties, which should produce impressive returns. Our full-cycle track record is evidence of the success our people have achieved together. The leader of our success is Eric Barvin, a visionary known for his integrity and empowerment of others. Next, Eric Barvin will share his outlook on the multifamily industry. Thank you, Eric.
Thank you, Kate, for that fantastic introduction and overview. And thank you all for joining us today. I hope your takeaway from my presentation is that despite market volatility, and actually somewhat because of it, multifamily is a great place to be invested. Also, that Barvin is a strong operator focused on delivering value to our partners. Part of providing that value is identifying new opportunities. We foresee some great investment opportunities resulting from dislocations in the market due to recent macro factors. All of these items will be covered in more detail shortly. Despite the dislocation just mentioned, the market fundamentals we are witnessing in the industry today are some of the best I've seen in my career. The long-term attractiveness of multifamily is driven by a few key factors. Demographic trends like the increasing rate of household formation, a growing percentage of renters and domestic migration favoring our target markets. Moving hand in hand with this trend is strong job growth. The employment market remains robust, particularly in areas Barvin operates, where we see a huge number of corporate relocations and new STEM jobs that support the resident quality of our Class A properties. Amid all of this, the housing market remains in a long-term trend of undersupply. Builders did not regain their footing after the Great Recession, leading to a massive shortage in housing, according to numerous studies. Roughly 5 million residential units total. As construction and financing costs continue to accelerate, future supply additions that were previously planned are now delayed or removed from market projections. As we all are aware, there remains an enormous strain on the housing market. The National Association of Realtors has reported that the median income family in the United States can no longer afford the median priced home. In September of 2021, the median income was $30,000 above what was required to qualify for a loan for the median priced home. Less than a year later, it is flipped. This is due to the increase in interest rates that have more than doubled the monthly mortgage cost. The income necessary to qualify for the median home is now higher than the median income. The affordability dilemma is driven by the underproduction of housing, consistent demand growth, and higher financing costs. In a recent consulting survey, 24% of Texas homebuyers have given up and decided to remain renters. That number is more than double the national average of 11%. Another data point I want to highlight is that the median monthly mortgage payment today is 50%. Yes, 50% higher than the median monthly rent. We view this as an incredible tailwind for multifamily housing. Demand is unlikely to subside anytime soon, as highlighted on the bottom half of the slide. The 2020s are projected to see roughly 50% more household formation than the 2010s, driven by new generations moving out and joining the workforce. In an environment where you have renters forced to remain renters longer, it means rental rates will move higher. Demographically, we see population growth subsiding in the coastal metros, like New York and Los Angeles, for which the last century have been the traditional areas of growth. The Sun Belt, especially Texas, has taken up the slack. From 2015 to 2021, Los Angeles experienced an exodus, while Austin, Texas grew its population over 15%. This trend in net migration is reflected in the chart on the right. But what is causing it? In part, it is the lower taxes, friendlier regulatory environment, and generally pro-business stances of states like Texas and Florida, which have created a boom in business activity and job growth. Texas alone has seen a record number of corporate relocations over the last few years, as companies seek refuge from the difficult business environments in California, New York, and other states. Texas has taken the crown from New York and now leads the nation in the number of Fortune 500 companies headquartered in the state. Combining the population and job growth trends together, this slide illustrates the superiority of Texas relative to other states. As of July, Texas led the nation in job growth at almost 6% year over year. Texas also led the nation over the previous year in new residents, adding over 300,000 new residents. But interestingly, all of this increasing activity has not been matched in terms of housing. There has been construction and recent additional development, but there remains a delta between supply and demand that has been building for several years. On the left, we can clearly see underproduction since the 2008 financial crisis, as builder confidence was shaken to the core. the industry has only slowly recovered, leading to the shortfall studied by the National Association of Realtors and Freddie Mac, among others. Rising interest rates lead to higher cost of financing, higher construction costs, and recession fears. CoStar is now predicting a large drop-off in deliveries of multifamily housing, as we can see on the right. So despite a short-term oversupply of multifamily relative to average deliveries in 2022, we are in the midst of a much larger, longer-term undersupply. So far, we have discussed the encouraging supply and demand mechanics of the industry. However, the elephant in the room for real estate is rising interest rates. When we closed 3 investments in December of 2021, the upper range of the federal funds rate was 25 basis points. It has since increased more than tenfold. The 2022 interest rate hikes are the fastest in modern U.S. history. The chart on the left shows the analyst predictions of the Fed funds rate as well as historical rate movements. These predictions habitually overshoot actual rates. However, this year has been an exception. The forward curve is currently predicting a peak in interest rates in early 2023. On the right, you can see our debt service projections on the 3 investments that closed in December of 2021, which were based on the Chatham forward curve for 1-month LIBOR. The debt service paid in August ended up being substantially higher than the forward curve at the time of our underwriting. We are fiduciaries for our partners, and all of our floating rate loans have caps to protect from interest rate risk, as depicted in the bottom right portion of this screen. Nevertheless, on these 3 assets, we have elected to temporarily suspend distributions to reserve cash in order to tackle any challenges that may arise head-on and position our properties for continued success. In addition, Barvin will be deferring asset management fees to contribute to the cash reserve. Given the uncertainty in today's economy, we believe a focus on the creditworthiness of our residents is increasingly important. Class A residents pay a lower percentage of their income in rent, given their higher earnings. Therefore, these upwardly mobile residents have the ability to absorb higher rents in the future. For Class A residents, the median income of $80,000 per year equates to roughly a 20% rent-to-income ratio, compared to workforce housing residents that experienced substantial collection challenges during COVID. Clearly, we have high conviction that Class A multifamily investments will outperform in the future as they have in the past. Over the last 20 years, real estate investment trusts have generated superior returns relative to other asset classes. During this time, the average investor earned only 4%, while the traditional 60-40 portfolio earned 7%. However, REITs, on average, returned over 11%. Multifamily in particular generated stronger returns than the industry, agnostic REIT average. Combining both income and appreciation, multifamily investments generated a 13% annual return, including a strong recovery following the Great Recession. Over time, well-positioned real estate assets, and especially multifamily assets, clearly outperform. Today, we see strong opportunities in multifamily investments. Given the rise of interest rates, it is very important that the multifamily properties we build or buy have the capacity for rent growth. Oftentimes, you can discover rent growth potential through analyzing loss to lease trends. You can pro forma the increased rent growth that can lead to a higher cash flow and valuations in the future. We are focused on locations and on quality that will generate strong cash yield and benefit from appreciation over time. Initially, the cash-on-cash return for opportunities might be light, but the right locations can benefit from rent growth very quickly. Our team's goal is to find where the economic growth and job creation will be. The chart on this slide illustrates that long-term multifamily investing generates a strong risk-adjusted return. I believe that some of the best multifamily investment opportunities over the next decade may occur in the next 2 years. People often ask why they should invest with Barvin. I've got your answer. Barvin's direct investment structure allows investors to select properties that they want to own with a sponsor they trust. In addition, direct investment structures offer roughly 200 basis points in alpha relative to funds utilizing capital allocators. This is due to high fees in funds and double promotes that occur. I will always advocate for investors to invest less across more deals to spread out their investment and create a portfolio with our properties in order to achieve diversification and generate superior returns. Barvin is also exceedingly selective. Out of approximately 200 deals underwritten year to date, we have decided to move forward with one acquisition so far in 2022. This acquisition has assumable fixed rate debt financed at a rate of 3.2% for 30 plus years and a great location with significant barriers to entry. As mentioned before, I'm one of the largest investors in each project, committing my capital as an LP investor alongside our high net worth investment community. Lastly, investing with Barvin is simple. All accredited investors are welcome. Please ask to be added to our distribution list, and we will include you in our deal flow as we find opportunities that achieve our selective criteria. I'll now turn it over to Randy, our Chief Operating Officer, who was previously a member of our advisory board and made the decision to join our company at the end of last year. Randy will speak on the portfolio composition and operational performance. Thank you, Randy, for everything you do for the company.
Thank you, Eric. It's great being part of the team. Overall, Barvin's operations are moving in the right direction. I'm excited to share our portfolio updates and hope your takeaway from today's presentation is that Barvin is a good operator and a trustworthy partner. Following our transition to in-house property management this year, we are witnessing strong rent growth and occupancy trends, which are driving consistent improvement in revenue per unit. The first slide in our operations update reflects our same-store property performance broken out by class. Same-store assets have been owned by Barvin for more than 12 months. The chart on the top left shows Class A revenue per unit over the past 4 quarters increased on average 4.4% each quarter. This chart also shows our controllable net operating income per unit. Controllable net operating income is the net operating income from all operations, excluding property taxes and insurance. This number reflects on-the-ground results at the property level. It includes items such as payroll, utilities, maintenance, and marketing. Modestly outpacing revenue growth per unit, our controllable net operating income for Class A same-store properties improved 4.7% each consecutive quarter. The growth rate spread between these two numbers highlights our operational efficiencies through expense controls. For Class B and C properties, we also see a trend of increasing revenue per unit. Controllable NOI per unit for our workforce housing portfolio increased dramatically, as there was ample low-hanging fruit for our in-house property management teams to address. Impressively, our controllable NOI per unit grew 15.2% since the third quarter of 2021. On the right, you can see the occupancy charts. Physical occupancy for Class A stayed above 94%, rising to 96% in the second quarter, while economic occupancy saw meaningful growth as COVID-related concessions rolled off of our financials. Moving to the chart in the bottom right corner, we see physical occupancy for our Class B and C properties remain constant, while economic occupancy saw sizable growth as we restaffed our in-house property management functions in early 2022. Economic occupancy is defined as total rental income over current net rent potential. Effectively, it captures the revenue generated compared to what we can achieve in the market. Said in another way, it captures the impact of concessions, bad debt, and rental rates that are below market. It's the way we grade our operational performance internally. As you can see, for our Class B and C same-store portfolio, we've reduced the spread from occupancy and economic occupancy from 10% to less than 4% in a year. On the next slide are our newest properties, which we have held for less than 12 months. Each Class A property is well located in high-growth urban submarkets of major Texas metros. With 2 full quarters of operational data to share, we've seen early improvements in rental rates, occupancy, and expense management. The occupancy numbers in the lower right chart are modestly skewed as BG 20 North Lamar did not reach stabilization until the end of the second quarter. We're planning to bring both BG 18 Crockett Street and BG 20 North Lamar under in-house property management and plan to achieve the same success we witnessed at our San Antonio and Dallas properties that made the transition earlier this year. In-house property management provides us with direct access to our customers for optimal customer service. We are witnessing almost unprecedented lease tradeouts and renewal rate growth driven by some of the fundamentals that Eric discussed earlier. In the second quarter of 2022, new lease tradeouts averaged 9% among same-store properties, while renewal lease rates increased 14%. Across our portfolio, the rental rates from renewals jumped 10% during the second quarter of 2022. Class B and C same-store properties saw renewal lease rates increase a respectable 10%, while non-same-store properties experienced modest increases as well, despite lease-up specials and other incentives that were being offered on new properties in the surrounding areas. Our older Class B assets continue to have extensive capital maintenance expenses. Additionally, there is the issue of residents not paying rent and difficulty in the court system to actualize evictions in a timely manner. We're concerned that the bad debt issues of this demographic will become exacerbated if we do have a recession. Given our cost basis on these properties, we feel that it's the right time to monetize them. These properties include the legal names seen here, but also known as Chateau Dupree, Memorial Towers, Park at Voss, and the Daphne. We've listed or plan to list each property for sale in 2022 following the material rental rate, occupancy, and expense control improvements our operation teams achieved this year. The monetizations will return a significant amount of capital and liquidity for our investors. We hope to offer 1031 exchange opportunities through our acquisitions and development arms to execute on the most efficient tax structures at sale. Our retained portfolio reflects the strong numbers shown earlier in this presentation. Each of these properties has a clear path of improvement and increasing value, and each is anchored in strong demographics and market trends. BG 13 1125 Hammond and BG 16 Bishop Arts have experienced 17% and 15% increases in revenue year over year, respectively. This slide reflects the predominant Class A portfolio of Barvin in the future. Not included on this slide, but worth referencing, is our Houston Medical Center Opportunity Zone development project that began lease up last month. In 1 month's time, we've leased over 20% of the units and look forward to expanding our ground-up development initiatives in the future. Thanks for taking the time to review our operational performance and portfolio strategy today. Our team is proud of the accomplishments we achieved year to date, and we're only getting started. We look forward to answering your questions at the end of the advisory board panel in our Q&A session. Next, Eric will conclude this segment of the presentation and introduce our advisory board, which is how I was introduced to Barvin 2 years ago.
Thank you, Randy, for that thorough review. I'm grateful to have you leading our operational efforts. I hope I have made the case to everyone that multifamily investments in our target markets are attractive investments given the trends we explored and given our track record and reputation. Randy walked us through our portfolio performance and highlighted our operational success. Now, in preparation for price dislocations in the market and the distressed assets of poorly positioned funds, we are readying ourselves to secure what may be some of the most attractive investments we've had in years. We at Barvin are very excited to see what the future holds and are working every day to ensure that this future is a very profitable one. We'd now like to invite our distinguished advisory board to discuss the current climate of multifamily investing. I'd like to thank each of them for taking the time to contribute. The advisory board is an incredible asset to our organization. They provide direction, wisdom, and accountability. We are better for having them on our team. Gerald Murfish, who's a member of the advisory board, was unable to join today, but he sent a pre-recorded video, which we'll share later in this panel. Gerald is a trusted advisor and was an established CEO for over 40 years with commercial banking and transactional experience. Today, he provides the voice of an experienced investor and business strategist on our advisory board. With us today, we have three of our four advisory board members, Gotti Kaufman, Steve LeBlanc, and Jarvin Shen. I'd like to go around and have each advisory board member briefly share their background before we begin the panel discussion. Gotti, will you please start?
Thank you, Eric. First, I want to say it's a great pleasure and honor to serve on your board. I love our co-board members, and I appreciate the opportunity to help you guide your company into the future. And it is a truly a great experience for me. Again, my name is Gotti Kaufman. I'm chairman of RCLCO. We are a real estate advisory firm. We have three basic verticals. We do economic consulting, management consulting, and advisory services for large institutional investors, all in real estate. We're located in 4 offices across America, and we work around the world. Thank you very much for the opportunity to be here today. Now allow me to introduce my good friend, Steve LeBlanc.
Thank you, Gotti. As Gotti mentioned, it's a pleasure also and an honor for me to serve on the advisory board with Eric and with Gotti, Jarvin, and Gerald. My background is 4 decades as a multifamily owner-operator. I first started as a partner with Lincoln Property Company, running Texas and the Northeast. I then moved over to the real estate investment trust industry, helped grow Archstone, a New York Stock Exchange REIT, into the second largest multifamily REIT on the New York Stock Exchange. I was then CEO of Summit Properties, a New York Stock Exchange real estate investment trust focused on the Southeast. We had great success at Summit. We sold to Camden Property Trust in Houston in 2005. I was able to move back to Austin and began teaching at the University of Texas, teaching real estate in the McCombs School of Business. I was then recruited to be the head of real estate and private equity for the Teachers Retirement System of Texas, a $200 billion pension plan for all the public school employees of Texas, 1.5 million. And I ran the private equity and real estate portfolio. We made over $30 billion investments, 100 different investments with multiple partners. And our focus was the ability to select and choose and partner with the best investors, the best partners in the world. After TRS, I started my own private equity real estate company. Great success there, CapRidge Partners. We raised 3 funds, and I was able to sell my interest to my 2 junior partners. I now run my own family office and serve on numerous boards, including Barvin. So thank you very much for the opportunity. And now let me introduce Jarvin.
Thank you, Steve. And again, I want to reiterate the pleasure of serving on Barvin's board. It's been, so far an amazing experience. Again, my name is Jarvin Shen, and I'm a co-founder and managing principal at Mount Auburn Multifamily. The firm was started in 2008 during the depths of the Great Recession, was recapitalized and restructured several times, and ultimately became a multifamily private REIT focused on Class A workforce affordable housing in the Sunbelt cities. Clearly, I thought there was a lot of synergies between Mount Auburn Multifamily and Barvin, which I hope to further instill upon Barvin. Earlier in May 2022, Mount Auburn sold a 10,000 unit portfolio across 33 properties to Starwood, the S REIT. And now we're currently running a lending and acquisitions platform for Canadian Sovereign. And again, pleasure is all mine to be serving on Barvin's board.
Thank you, Gotti, Jarvin, and Steve for joining us today. I'd like to get into some of the questions now that I'm sure our viewers would like to learn from your wisdom. So we spoke today about the structural undersupply in the housing market during our presentation. Gotti, do you see this issue abating anytime? Also, what do you think this means for rent growth?
Great question, Eric, and I appreciate the opportunity to talk about that with you and with your investors and colleagues. First, I don't think the issue abates quickly or anytime soon, and I will provide some background on that. And I think the impact is that it's going to truly provide tailwinds, support under further growth of rents over the foreseeable future, given some of these demographic patterns, let alone other topics like inflation and other inputs. So let's focus first on the demographics and why the undersupply is not abating anytime soon. First, let's talk about the size of the undersupply. If you look at the census information comparing what happened in America for population and household growth between 2010 and 2020, you will find that there are about 9.1 million new renters that were manufactured in the market. About 3.9 of that was population and household growth, new household formations, and the percentage of those total households that are renters as opposed to owners. And then the balance is the transition of about 4% of the population of the households in America that were homeowners in 2010 and became renters by 2020. That's 6.2 million, together 9.1 million households. To dig a little more about the 6.2 million, because it's an amazing and perhaps even awesome number. There's 130 million households in America as of 2020, 2 years ago. 35% of them are renters, and 4% of those, of that 130 million, have transitioned from ownership to rentership. So 4% of 130 million is 6.2 million. So that's a very large pent-up demand for rental housing that came into a market that already did not have sufficient inventory, particularly not in the high growth regions of the country, such as Texas and Florida and Arizona, where jobs and people needed to and wanted to move, and the opportunity was created. So out of the 9.1 million households that became renters during the decade, 2/3 of them live in rental units that are in multifamily structures, the kinds of product that you, Eric, invest in. And 2/3 of 9.1 million would equate to 3.8 million units. That's 6.4 million new units of demand created. During the decade, 3.8 million units were built. So 9.1 million total renter households, 6.2 of them want to live in multifamily units. 3.8 million multifamily units were added. That yields a net unmet demand of 2.6 million units in America. That is an enormous number when you compare that with a production rate of about 400,000 units a year. We may be able to get to 500,000 units a year of production of new rental housing in America, and that'll take a major lift because our supply chain and our infrastructure of construction companies and availability of land will make it very challenging to get to 500,000 units a year. But to close a 2.6 million gap is going to take a long time. In the meantime, we continue to add renter households in America. Currently, we're adding about 400,000 multifamily renters in America every year. And that is driven by population and household growth. So the current construction levels at 400,000 units per year is barely keeping up with the demand of new household formations, and that 2.4 million, 2.6 million pent-up demand or overhang is yet to be worked off. So that will continue to create pressures on demand on prices as demand exceeds supply for the foreseeable future. And therefore, I think we should conclude that over the next few years, there will continue to be more demand than supply for rental units. New units will be built and rents will continue to move up in those new product that is being built, and rent in existing inventory will be drafting behind it.
Thank you, Gotti. I appreciate you sharing. One additional insight that I think is also important to mention is the decline in development that is expected to occur over the next few years, given interest rate rises recently, and how this decline from a 400,000 or 450,000 unit peak could likely be cut in half over the next few years, and we'll fall behind again. I'd like to now ask Jarvin what he sees as the biggest opportunity for creating value in the multifamily space today. And before Jarvin goes in, I'd like to just talk about a little bit how his firm was recognized nationally as an incredible operator of multifamily and capital. And so thank you, Jarvin, for joining us, and look forward to your insights.
Great. Thank you, Eric. Like I'd mentioned before, I see a lot of similarities in terms of what my firm has done and what Eric and Barvin is actually doing right now. So to answer this question specifically, I would say it would be to focus on operations and specifically build out property management and asset management platforms. Again, just by parallel, I think Barvin so far has done an outstanding job focusing on acquisitions and development, and obviously, will continue to do so. And now that Eric and Barvin has a significant portfolio of assets, I think this is the right time, as he recently has been focused on building out property management and asset management in-house capabilities. From personal experience, I think this is a key critical component of growth and value add. When I started multifamily in 2008, I was focused on building a portfolio much like Barvin. In 2012, my firm bought a property management platform and took on a couple operational partners to complement what we were doing on the investment management side. Ultimately, this proprietary property and asset management platform essentially became the basis of the recap that I spoke about earlier in my intro of our legacy fund assets into a private REIT, which was, again, thank you, Eric, it was pretty well recognized as a competent multifamily operator. It's so obvious to say that once you acquire and own, you have to manage. And if you manage over the harvest period, there will be incremental and compounding yield that upon sale will translate to a higher capitalized long-term value. Said differently, you can't change the going in cap rate or purchase price after acquisition, but you can change the yield on cost at exit. And small annual and compounding changes to that, again, will yield significant long-term value. That's the next natural evolution we are working on at Barvin. Some color in terms of property management initiatives that Barvin is now in the process of implementing are, number one, I would say defining endpoints, not just financial metrics like rent growth and net operating income, but operational endpoints like renovations or turns within a defined period, capital associated with such turns, response times to lead generations, and marketing dollar yields like foot traffic and conversions to leases. Two, I would say data centricity. This would be capturing and leveraging data to see what correlations may exist and what becomes statistically significant to operations and ultimately creating value. And the third point, I would say, a constant re-underwriting of existing assets from real-time historical results. Those would be juxtaposed against current property market values and expected rent growths, really to determine the highest and best use of capital in projects. And finally, I'd add that we're actually just did a teach-in between my firm and Barvin's operational teams this past week, for Barvin to really understand and start implementing these various technologies, systems, and other management implementations.
Thank you so much, Jarvin. I'd now like to ask Gotti if he has anything to share where he sees opportunity in creating value in multifamily today.
Eric, every time I hear Jarvin, I am awed by the wisdom and experience that he's willing to share with us. And I couldn't really supplement what he's saying any better than he could. I would say this, that, and it's a topic, Jarvin, I think you will agree with me on, and that is that excellent real estate investing in operations is the product of strong vision on the part of the leader and the conviction of the leader and the rest of the firm around and behind that vision. And then the selection of the investments that you make. You kind of make your money on the buying real estate. And it is not obvious all the time how you're making money on the buy, particularly in times like today, when prices are very high and when the rates of return seem to be more challenging to obtain. But history tells us that investing throughout the cycle, if you buy the right assets at the right time and you have the appropriate vision for that property or for that portfolio, it'll more than just work out. And multifamily apartments shines as a bright light among all other real estate asset classes to prove that point. So I think that, and I believe that Barvin does have that vision, you personally, Eric. The company understands that vision and has got strong conviction around executing to that vision. And then now with the analytics that Jarvin was talking about, deployed well, you do the right job in selecting locations, selecting assets within those locations, and selecting the right people to implement those things. So those all combine together to creating better outcomes than the competition.
Thank you again, Gotti. Now, as stated earlier, Gerald is unfortunately unable to join us today. However, we would like to share this pre-recorded clip with his thoughts on investing with an operator as an LP.
Hi, I'm Gerald Murphish. I'm a member of the Barvin Advisory Board. I've been involved with Eric Barvin as an investor for over 11 years. I hold a BBA and an MBA from the University of Texas at Austin. I spent the next 5 years of my career in commercial banking as a lender, and then came back to Houston to join my family business where I served as a leader and CEO and chairman of the board for 43 plus years. Recently exiting that in October of 21. My role on the board is that of being the voice of the investor. As an investor and not as a multifamily specialist, as the other members of the board are, I find that that's the process, that my responsibility is to speak on behalf of the investors. Well, first of all, I want to share that I invest with people and trust their judgment. I'm not looking for a quick profit. I'm looking for long-term stability and success. When I think of a good operator in the multifamily real estate business, I think of someone that aligns their personal success with the success of their limited partners. Do they have skin in the game? Do they have LP interest as well as their GP interest? Do they have a fair fee structure, and is their promote structure fair? As an investor with Eric for over 11 years, Eric has produced for my family above market returns. He is a man of integrity. So I invest in people.
Thank you, Gerald, for sharing and your support. Sorry you couldn't be here today. Now I'd like to ask Steve, given his experience at TRS and placing, like he said, $30 billion of capital in 4 years with other operating partners, how he defines a great operator in our industry and how should investors define their real estate sponsors?
Thank you, Eric. As Gotti mentioned, the multifamily industry has a tremendous wind at its back. Demand exceeds supply. It's difficult to put new supply on the market. The supply is growing every year. And so we've got great market conditions for multifamily. And as Jarvin mentioned, operations, they are the key to multifamily. You do need to make a great acquisition in the buy, as Gotti mentioned. You also have the opportunity to improve the performance through detailed operation excellence, which Jarvin has a track record of doing, and Eric now is working with Jarvin to build that out. So now that we have a good macro environment and we have excellent operations, how do we as investors select a good operating partner? I would tell you that I believe there are three things: trust, track record, and tenacity. So let me talk about each one of those three. For trust, you need to make sure that you trust your partner to do the right thing for you as a limited partner with your wealth, to make the right decisions, to put your interest ahead of his own, to help create value through building an excellent operating company. And I feel and I see examples of Eric Barvin. He certainly has my trust as an investor and as an advisory board member. And I believe he shows that excellent trust. You know, I've invested with Blackstone, KKR, Apollo, you name the top wealth managers in the real estate industry across the globe. And Eric Barvin is in the top decile, the top 2% for trust, character, and ethics. Markets don't always work out. And so you need to make sure in good times and bad times that your partner will clearly communicate both good news and bad news. And if the cart does get in the ditch, he'll put his shoulder to the grindstone to make sure he and his team are working hard for your wealth, to protect your money, and to do better than maybe market conditions will allow. So that's the key about trust. Now, what about track record? I believe in what I call a thread of success. When I look to find a partner I want to put my family office money with, I look for what I call a thread of success, and that they have had success throughout their career through multiple cycles and different sections, different time periods, different situations and markets. And Eric Barvin has proven that thread of success in multiple cycles and over the long term. He's also demonstrated a tremendous integrity and character. Again, when things have not gone right or well, he's put his own capital, invested additional capital to help the LPs achieve their return. That shows me that not only does he have a thread of success, but he is also someone I can trust with my family office's net worth. And the final character is tenacity. You know, as Winston Churchill said, never, never, never give up. We will have situations that will take difficult situations, difficult investments, difficult market cycles. And Eric, I believe, will always work hard for his investors' capital and wealth to preserve it, to protect it, and to grow it. Those are the three things that I consider to be the most important in selecting an operating partner: trust, track record, and tenacity. And I am confident Eric shows the best of all three of those characters.
Thank you, Steve. I appreciate you sharing your feedback. Thank you to the advisory board, Gotti, Jarvin, Steve, and Gerald, for sharing your wisdom today and your insights with our colleagues and investors. We appreciate all of your support and your direction and keeping us accountable. Now we'll transition to a live Q&A that we look forward to you participating in. Please give us a couple minutes to get set up. Hey, and we're back. I'm joined today with the Q&A with Randy L., who you met, who's our COO during the presentation, and then Derek LaRue, who's our Vice President of Development, and Mark Foracore, who runs property management for our company. And so we appreciate your questions. We're going to try to get through everything. And I'm going to start with Mark. Mark, what are the benefits of in-house property management? And can you give specific examples and address challenges as well?
Yeah, you know, as I was sitting and I was listening to some of the advisory board members talk, I think Jarvin said something, and I wrote it down. I'm not sure if I quoted him exactly, but he said, if you own, you have to manage. I heard him say something very similar to that. And I 1,000% agree. Based on the business model that Barvin has, if you're going to own, we need to self-manage. And I think the analogy that I like to use when I think about that situation is that nobody washes a rented car. If you rent a car and you're driving it around on the street, you're not very inclined to take it through the car wash and clean it. You're going to return it in good condition and it's going to run, but it's at the end of the day somebody else's car. And property management is a little bit like that. If you're doing third-party property management, and I've been on both sides of that desk, by the way, and so I've seen it from both angles, you really are not as focused on long-term results as you are when you self-manage. We have a lot of processes in place and we have a lot of systems that we think are very, very good. And I think as an example, I would look at some of the recent takeovers that we did in San Antonio, where there was some friction on the turnovers. And one was completely, absolutely smooth as it possibly could be, and the other one had some challenges to it. And it wasn't that our fee management company was a bad operator. They're a very reputable, big company, and they did by all accounts, a very good job. But there was opportunity at one of those two assets that we were able to capitalize on very quickly, upgrade some infrastructure, address some deferred maintenance, and see some immediate quick results and hits from those things. So there really is no better steward of our assets, no better fiduciary to our owners than ourselves, and that's really what it's all about. Randy, if I left anything out.
No, I love Mark's saying about nobody washes a rental car. And Mark and I have both been on the same side. We've done both third-party property management and in-house. And I think it's always best to have the owner's people on site. I think we try to instill in them, as Mark said, a long-term attitude that we're going to own this property for a long time and that we're in it for the long haul. And if you're able to do that, and they know that, the owner, comes out to visit the property and that they're part of that team, I think they always are better stewards of that asset. And it makes me sleep better at night that we have our own people on site.
Thank you, Mark. Thank you, Randy. I'm going to, ask the second question to myself. And just a reminder, there's a Q&A chat button at the bottom of the screen. So if you do have a question, please submit it. We're watching and we want to answer them. So the second question is, can you talk more about your thoughts going forward with higher rates and the possibility of a recession in terms of performance, income streams, returns, and refinancings of various properties? So a little bit to unpack in the question, but I'll do my best. So moving forward with higher rates, as we've mentioned, there's clearly an impact on our current portfolio, an impact on properties we want to acquire, and an impact on our peers. Absolutely. JLL, who did a lot of our financing, said that 70% of financings they did in 2021 were floating rate debt. So we're definitely not the only operator who's experiencing this increase in interest rates. The second piece is that there is tremendous rent growth, and we are working on a portion of our portfolio that has these interest rate caps to ensure that we can get rent growth, NOI growth to both create cash flow for the cap purchases, which we think will be lower than they are today. Today, to buy a cap is about $1 million for our size loan, maybe $500,000 for a 1-year cap, but $1 million for a 2-year cap. And as we get to next year, when our caps do expire and the forward curve continues to increase, we will get to a point where the forward curve begins to decline. And that will bring down cap costs tremendously. But we want to be prepared no matter what, which is why we pause distributions. I think that the case for a recession could have an impact across our portfolio. I think when recessions do occur, they focus on specific industries, specific cities, and they hit cities some more than others. And so it's our goal, whenever we purchase a property, to look at the drivers of the employment, the drivers of the economy, and to ensure that it's recession resilient. I don't want to talk specifically about one market or another, but I think that all the markets that we're in will do well even during a recession, given population growth, which is a key driver for multifamily. Our portfolio is made up of less than 50% floating rate debt. The majority is fixed rate debt. And fortunately, we don't have any properties that we want to keep that are maturing in the next 24 months from a loan perspective. Our renters are spending somewhere between 15 and 20% of their income in rent. Those renters are going to have trouble buying homes. As we saw in the presentation, the cost of a home just doubled from a mortgage perspective, essentially. And those renters can afford to pay more in rent. If you look at B and C properties, the typical renter spends 35% of their income in rent. So we're focused on these renters that can afford to pay more, and we think they will pay more over the next couple of years as their options to buying a home or moving somewhere else become less available. So Randy, with interest rates moving higher, what do you see as the biggest opportunities to improve our operations and accelerate investor returns?
That's a great question. It's interesting. Some of the things that we've seen take hold I would say in the last 18 months, maybe, and really starting to take off this year, revolve around our staffing models. We've had the same staffing models for, as long as I've been in this business, for 40 years. And so there are people out there, and actually Mark in his last role explored this idea. And I think we're going to explore it early in 2023. And that's the idea of centralized operations, where, realize on site, we have accounting functions that go on, we have sales functions that go on. And the idea behind centralized operations is that you take one or two individuals and you have them take care of all the functions for, say, accounting, doing the sodas on move out, doing the rent increases, those accounting functions. And if you centralize those operations for accounting and possibly sales, you create efficiencies and consistency. And that will help drive financial performance. It will help reduce expenses, and you'll actually end up with better customer service. So I think that's something that's going to take hold more, and we're definitely going to explore in early 23. But overall, when I think of the best way to drive revenues, it's really a talent management and acquisition idea. And that is, over our goal is always to hire, train, and retain the best people in the industry. We do personality measurements, trying to match people with jobs. Jobs have personalities, people have personalities. You get the most out of people when their natural abilities are utilized in the jobs they do. And I think the operators that will deliver the best performance will be the people that have the best teams and the best people. And so we concentrate on that all the time. And I think going forward, it will become more and more important, especially if we go into a recession.
Thank you, Randy. Our next question is for Derek on the development side. Given what's going on in the economy and a potential slowdown for multifamily development in general, do you see development opportunities in the next 24 months going forward, or do you see opportunities to build instead of buy properties right now?
No, that's a great question, Eric. I think that we have the opportunity to see some imbalances in some markets, and that imbalance is going to give us an opportunity. We look for real estate fundamentals everywhere we go. That's job growth, demographics, and locations. But I think there will be opportunities as inflation causes rental rates to increase. Potentially, we have construction costs that maybe stay at the levels they're at. I think imbalances will present themselves, and that's an opportunity for us to capitalize on new development.
Thank you, Derek. Thank you. We also, just to plug, we do have our Sell and Braze project coming soon, which Derek's been working hard on. And we think even with these rising rates, actually still pencils because we bought the land 3 years ago. So we're very excited about it. Another question for me: why did we use floating rate debt in 2021? That's a very good question. And which economic forecasters do we use to look at this data moving forward? So I'll first talk about the premise of floating rate debt versus fixed rate debt. So floating rate debt allows flexibility. It allows you to refinance. It allows you to sell. It does give you flexibility to revalue your asset if you've created a lot of value. So if you look at the acquisitions of 2021, the property in Bishop Arts has lots of retail. So the retail was all vacant. We felt that there would be a lot of value created when that retail was leased, and we wanted to be able to maximize that. If you look at the 3 acquisitions in December, we felt that those properties all had considerable upside. Aura on Lamar and Austin being, I think, maybe 50 or 60% occupied, and then Crockett and Heights with significant concessions to burn off those concessions and create tremendous value. And that's why we utilized the floating rate debt at the time. Obviously, hindsight is 2020, and if we go back and change it, at this moment we would have. But we do use professionals in the interest rate space to make these decisions. And our consulting firm that we use a lot is CIRM, a Commercial Interest Rate Management. And these are all based on their guidance. they were wrong, which can be frustrating to us and to our partners, I'm sure. But I think a lot of the market didn't predict this coming. I think the vast majority did not predict this coming. And as I mentioned previously, JLL as an example, 70% of their loan originations were floating rate debt. So we're not the only participants, but again, I think we're well positioned with the demographics, with the kind of properties we have, with the locations we have to power through it and get past the rising rate environment. Mark, another question for you. How are the Texas markets holding up in terms of rent and occupancy, and any luck on the retail space at any of the properties?
Great. So yes. So occupancies throughout our markets are holding up well. When I think of where the market is at today, and I look at our submarkets and how we're doing against our comps in those markets, I see strong performance. I see comparable performance just generally across the board. In general, Houston is one of our markets that's most challenged with occupancy, followed by Austin, and that's maybe a little bit of a function of the property that we have there and the fact that it's just gone through a lease up and is now into its first generation of new renewals and new leases. And then Dallas, and then followed by San Antonio with some of our strongest performance. In general, from a high level, I'm seeing good, strong trade outs on new leases and on renewals. I think that our occupancy and our trade outs, again, for the market are very strong, and I really don't have any challenges or concerns today with those. I think that there's going to be some headwinds going into third and fourth quarter. It's kind of natural that those things happen. The cycle for multifamily is just that, the strongest markets for the turnover, the strongest time periods for turnover in general are the summer months. And then as you get into the third and late into the fourth quarter, it becomes a little more challenging. But we've adapted our lease expiration schedules, and we're continuing to work on that to minimize those impacts. And I think we're going to be really well positioned next year when we come out with a refined, much better lease expiration schedule that's going to allow us to really capitalize on those opportunities when the time comes up. Oh, and then retail. I'm sorry, there was a second part to that question. So that's one of the things that I think is a real success story. I think at Vance and Bishop Union, we have about 23, maybe 24,000 square feet, which is a lot in a multifamily property. And we've got a really, really strong lead on a good chunk of that. I think about 20% is currently pending a final signature for a lease to go forward. And we've got really strong leads, some LOIs going back and forth on some of the other space in there. I think all in total that would comprise about 40 to 50% of the total space there. Some really unique opportunities, potentially a local takeout pizza place, a tapas cocktail type of establishment, and then a nice salon type property that I think would all add value to the asset. When you think about the income streams that are generated off those retail leases, it's not just the money itself or the CAM reimbursements, but almost more critically, it's the value add to the residents who live there. So, if you're living in that property, you can go downstairs and get a great piece of pizza or have a cocktail or get your nails done or whatever it is that you need to get done. Those only enhance the value of the property in ways that kind of pay off the secondary effects to that income stream. So feel good about it. And then in Austin, I think we've got a good lead on leasing up that 2,300 square feet of space there. So a good chunk of that I think is spoken for at this point with similar type commercial tenants. So we are making some good progress.
And I just want to add, I just signed the lease before the video today, for Salon Lofts in Dallas. So that's done deal. And I remember just how the world has changed in a year. We had a lot of investors that did not want to participate in projects with retail because of what was going on with retail at the time. And looking at the portfolio today, I'm grateful that we have the retail because that gives us an opportunity to really boost this NOI. And so it's kind of an interesting how the world turns. And just want to remind you guys how I feel fortunate today to have it.
Excellent.
Derek, another question for you. So throughout 2022, I know Kate and others have talked about this large development we're doing in Houston called Stella and Braze. It's a mixed use project. And are you still moving forward with it? What's the plan there?
Great question. And the answer is an absolute resounding yes. We are still moving forward. So we're excited right now to finalize our permitting process with the city of Houston, finalize our design, all of that leading towards a first quarter of 2023 construction start. Stella and Braze is a multi-phased mixed-use development that we're really excited about. The first phase is 312 units that will start in the first quarter of 23 and deliver in probably summer of 25. And so really excited to get that underway and absolutely looking forward to it.
Thank you, Derek. And that should be coming out to investors very soon. Derek says first quarter of 23, told me the second week of January. So that is the first quarter of 23. I'm focused on the second week of January for groundbreaking. Another question about interest rates, this for me, is do we expect to have any capital calls this year or next year? I'll say we're very, very focused on not having capital calls. I can't say, as a fact, we're not going to have capital calls. There's obviously always that potential in any sort of real estate investment. If you look at our track record, we've worked very hard to prevent capital calls in the future. And you can ask our partners in some of the other properties where I've contributed a lot of capital to make sure that we don't have a capital call myself. So I'm going to do everything we can to not have a capital call. We're currently deferring asset management fees. If we need to defer more fees, we can, and we will. We're currently evaluating our budgets for 23, and we'll have a better sense just on performance once those budgets are done. As for 22, I can pretty confidently say there's no capital call in 22. But where the question I think arises is when the caps expire, when interest rates go up. And so I think we need to do the 23 budgets before we can give any sort of guidance on that. Mark, construction of multifamily is at a 2-year high. How are you factoring the additional supply coming into the market when you look at rent growth?
Yeah, so that's a really interesting question. I think there's kind of a two-part answer. I think you've got to pull out what we're looking at to buy and answer that question separately from how are we adapting in the markets where we have existing assets. And I'm thinking right now of IC meeting that we've had just over the last week where we looked at a property that we were potentially considering an acquisition on. We saw the supply coming into the market. And it was one of many factors that kind of helped us get to a price that we felt that we could pay so that we're not overpaying for a property in a market where we see a lot of supply coming in. And that is a challenge. And it's got to be a careful balance. We want to do deals and we want to buy properties, and that's our growth opportunity. But we don't want to buy the wrong properties in the wrong markets where the supply and demand is out of balance. And when I think about the properties that we're operating today and how that construction level is impacting us, I think there's a little bit of data, and it's growing daily, to indicate that construction levels are going to taper off. I think that the record high levels are probably at the record high levels right now, and I feel like over the next few years, at least the next few quarters, that's going to significantly decrease. In the meantime, I think really what our goal is to have our processes, our people, our properties in a position to outperform the market, whatever that market is. We can't change the market necessarily, but we've got to outcompete everybody in it. And so whether that means higher occupancy, slightly better rents, better customer service, certainly, we can do all those things to ensure that we're competing at the highest possible level and getting the biggest piece of the pie in those markets where there may be a little bit of supply that's impacting our occupancy. Those are kind of the things I think about in answering that question. Randy, is there anything else you think that you'd like to throw into that?
No, I think you covered that quite well.
Thank you, Mark. Thank you, Randy. Another question for me. Did we evaluate the cost of purchasing an interest rate cap versus the cost of hedging the interest rate risk? And was there savings in the cap? So there's kind of two options to hedge interest rates. One option is to purchase a cap, and one is to go into a swap where you take a floating rate instrument and you convert it to a fixed rate instrument. So given our loan sizes, it's incredibly expensive to do a swap. And on top of that, it really eliminates flexibility in terms of resizing the loans and things like that. And so we went with a cap based on our consultants' expert advice. And obviously hindsight 2020, as I could say, And so we're constantly looking at fluctuations, but we do still believe that for the right assets, floating rate debt is a great vehicle. And kind of believe that even fixing today at today's rates could be a mistake, because as rates start to decline, you do want to take advantage of that drop. And when you're locked in a fixed rate loan, you can't. And so we're evaluating everything for sure on future opportunities and even on refinances. And so, but specifically to the last 3 acquisitions, it did make sense financially to do a swap. The next question is back to Mark. Mark, with costs up, what actions are underway to reduce costs while competing on service and quality to grow rents?
So Randy alluded to a little of this. I'll just go maybe into a little more detail and add one other component to it. In my prior life at my last company, we did spend a lot of time looking at ways to increase customer service while reducing expenses through centralization efforts. And what that really means is it's a fancy way of saying taking your sales processes and making people in silos the owners of those processes so they get really, really good at it and get down to the nitty gritty and can outperform somebody who's trying to do 2 or 3 different job functions in an office. That works not only in sales, but it also works in the accounting side. And through those specialized efforts, those people that really get good at those repetitive processes, you get the consistency that drives a superior level of customer service, whether it's in sales or accounting. What it also does is it allows the people who are on site and still interacting face-to-face with our customers to get really good at customer service. If the leasing consultant is no longer worrying about inspecting units for move out or handling other issues in accounting or doing other things within the office structure, they can really get good at making sure that our customers are taken care of and they're getting the best customer service they can get. I see also opportunities, throughout our industry to look at other areas where we can do it. Maintenance potentially is a place where we could do some centralization as well. We kind of do that in some ways, but there's probably some additional paths that we can explore down there. I think also getting more into the technology is going to help in these things. Mobile maintenance apps, the way that we can get more efficient by using that technology. Technology ideally offloads work and makes processes more automated. And if you can do that, and that's kind of what centralization does as well, but through technology you can accomplish some of the same goals, and you can really make yourself good at just being good customer service stewards of the property.
Thank you, Mark. Randy, question for you. Last week, read some headlines that housing prices are seeing double-digit drops year over year. Are you seeing that in Texas?
Housing prices decreasing, huh? Well, I can tell you my in-laws as an anecdote. My in-laws have been looking for the last year to move closer into Houston, back closer to where the kids live. And I don't think I've seen double-digit decreases in prices, a measurable drop in the price of single-family homes. But I do know that a lot of the home builders have excess supply that they haven't sold yet. And with the mortgage rates going up double, they're going to have a lot of homes on their hand. And I think you'll see them discounting those brand new homes or giving some sort of incentive, for upgrades and things that they'll give at reduced costs. I think, the D.R. Hortons of the world and the large home builders are going to start doing those kinds of things. But I think the Texas markets, real estate has held up a little better than most supply of real estate in the United States for single family homes.
And I could just add, I think the value drops, I think, are going to happen more with the D.R. Hortons and the Pulte homes there's no one living in those homes currently. They're trying to sell to a new market. And I think that they're motivated to sell. They don't keep homes on their books. And I think that probably where you'll see softness. So speaking of softness, another question, how much softness have we seen in acquisitions markets over the last few months? And what would I say that current cap rates are today versus 6 to 8 months ago? So it's interesting. We have seen some softness in terms of buyer pool. Like there's just not as many buyers, but similar to the single family home space, there's not as many sellers as well. And so when projects do sell, typically what we're seeing on a pro forma basis usually, maybe a year, maybe in place, but pro forma. They're selling somewhere between a 4 cap and a 4.25 cap, I would say, which is negative leverage. So our business model to date has been positive leverage, right? So we want to buy the 3.5 cap and finance it at 3 to have going in positive leverage. Today, multifamily, everything's negative leverage because I would say your long-term fixed rate debt is probably at 5.5. Your floating rate or your bridge debt, where there's value add or lease up, is really more like 6.25 to 6.75. So you're having significant negative leverage on any acquisitions, even at a 4, which is higher than it was 6 months ago. That being said, we looked at a property. I don't think we'll get it, but we looked at a property in Frisco, in Dallas, which is a high growth market. It's not managed well. The rents are low. It can be definitely improved. It's very clear opportunity. It will sell for a cap rate probably sub 3.25. So someone who buys that at a 3.25 cap and is financing it at 6.5, 6.25, is expecting tremendous rent growth. And we're starting to see buyers come back in the space, which is why we're listing our properties. We think that there's a lot of capital that has to be deployed by the end of the year, and a lot of people who are going to want to make fees by the end of the year, and so they're going to be hungry to buy deals. I also think that there's currently a little bit of a risk premium. Now, the sellers may not recognize that, but the lenders definitely are. So, what used to be a 280 basis point spread on a bridge loan is today about 400 or sometimes 450. And so lenders are getting this premium because there's this inflation risk and there's also recession risk. As soon as one of those two factors comes off the table, we know where inflation is going to go, or we know we're in recession, then that spread will likely come in. And so it's a very tricky time to buy. Like we mentioned, the program we're buying property Southline in the Pearl District in San Antonio. There's a fixed rate loan there, so it's kind of easy to understand. But when there is an opportunity, we're really looking at loss to lease and potential growth, and the goal of getting our cap rate or our return on cost equal to basically what our debt cost is, whether 5 or 6, but it has to be within like 12 to 24 months, which if you start at 3, doesn't really work because you can't turn rents that fast. So we're looking, again, we're patient and trying to pick our spots for sure. Mark, another question for you. Are you seeing an increase in delinquencies in the portfolio given rising expenses?
So it's a hard question to answer, but I'm going to take my best shot at it. I think I have not seen anything that gives me reason to believe that we're seeing more delinquency due to rising costs. However, I think it's entirely possible that that could happen. So what's going on right now with Barvin is that we're working very hard to make sure that the bad debt that we're writing off is being written off as quickly as possible. So delinquency, is the precursor to bad debt. So we're seeing some delinquency. We've historically seen delinquency in a lot of our portfolio, especially the B assets and lower, and those ones typically run a little bit higher in delinquency. The trend over the last 8 months has been that delinquency declining in general, and our write-offs with a few blips here and there declining as well. One thing that I think that needs to be included with this answer is that we're also being proactive to do our best to try and prevent that from happening by making sure that our rental site selection criteria is appropriate, that as new people are coming in and we're renting apartments, that we're qualifying people who have the right credentials to live on our properties, debt to income ratios and such. Of course, we always screen for criminal and credit, but the debt to income ratio then becomes very important. You want to mitigate your exposure to delinquency also by making sure that you're not getting taken advantage of by scammers. And it is a big industry concern right now in multifamily, people with fake paycheck stubs and false identifications, gaining leases under false pretenses that become immediate delinquencies. So we're focused on making sure that those things don't happen as well. Looking at it closely, making sure that it doesn't happen and addressing it if it does. But right now today, I'm not seeing it systemically.
Thank you, Mark. And I would just add, we use a lot of technology to prevent the scammers from being effective. Checkpoint ID to check IDs. There's a pay stub scanning service that really electronically evaluates whether the pay stub's authentic. And so, we've had a lot of success in avoiding the scammers with that technology. We have 2 questions left. The first is, if rates remain high in 2023, which is high likelihood, what's the backup plan for financing properties that have cap expirations? So I would first just like to say a cap expiration, so the cap expiring, does not mean that the loan has matured. So the properties with cap expirations in 23 do not have maturities in 23. So that's an important thing to note, that we do have to buy another cap, and we do have term left on the loan. So as I mentioned before, I do expect the cost of a cap to decline, given the forward curve and where people expect interest rates to be come May, June next year. That being said, interest rates will be a lot higher. And so right now we're reserving cash to both account for the cost of the cap and any shortfall in operations that would cause us to not make debt service. And so as we look at our budgeting for 23, we'll have a better sense of what that cost is. Again, they're floating rate loans. And so if the peak loan is, SOFR peaks at 4% as an example, and starts to come down to 2.5 to 3% or 2.5, within a 6 to 12 month period, we will benefit as it comes down as well. And so we'll see some relief. And so we don't expect it to go to 4% and stay at 4% for the foreseeable future. I think that would really cause a lot of havoc in the economy. And I think that the problem of inflation will be solved before they have to do that. And but we are gearing up, reserving cash to make that possible. Last question, where do we see the best investment opportunities today? What cap rates are we anticipating, properties that we buy? So I think that the first thing to state is we like development a lot. There's a tremendous cliff of new supply coming. And so anytime you have that, you end up getting increased rental rates and less supply, and then people start developing. But there's a few years coming out of that where you can really do well. And so we're looking at a lot of development sites because we think that's a good space to be in right now. We're always looking for well-located multi acquisitions. Obviously, we have to make it work financially. Our investors like cash flow. I will say anything we buy today most likely is not going to have cash flow, at least for the first year or two. The goal would be to get in at a good basis. And so as we look at properties, we're looking for 2 things. One is, we're always looking for location and condition and physical condition, who the renter is. But we're really looking for what's the loss to lease, meaning, basically where are their rents in place versus where the new rent's coming in at. And can we take those in-place rents up to where the new rents are? Secondly, what's the rent-to-income ratio on the renter? So if we feel that that rent-to-income ratio is extraordinarily low, 12%, 15%, and we can increase that because there's no supply coming and there's continuous strong job growth to 20%, well, we can pro forma rent increases that are above 3-4% a year. And we think that likely will happen in that space with high quality residents, with high quality properties. And so we're definitely specific. We're definitely not offering on everything that we see, very focused on specific submarkets and property types. We can pro forma these rent increases. If you're not moving rents up and interest rates move up, the property doesn't work. And I learned a long time ago, don't tell my mom, but the cash flow is more important than your mother. And so that's a focus for us, is to create cash flow. And anything that we look at today, we build, we buy, anything in our current portfolio, the goal is to get back to cash flowing properties. I'm an investor in all these properties, and when I'm not receiving cash flow, the team knows it. So we are working very hard to get back to cash flow distributions on all the assets. So I guess, this is the wrap. Thank you, Jordan, for joining us today. Thank you for being part of our investor pool, our support pool, our colleagues. We're very, very excited that you're with us today. And just want to reiterate that if you have any questions that were not asked, please reach out to our investor relations department. You can send them an email at investors@barvin.com, and we'll be sure to respond quickly. Also, I want to thank everyone again and reiterate my commitment to the company and to our partners. My goal is to build a great organization that stands the test of time. And you can see by the team we have in place, by our advisory board, by the technology that we're using, I'm making commitments and investments to maximize the value of the assets that we have. And that's incredibly important to us as well. As Steve on our advisory panel mentioned, I believe that Barvin is a trustworthy partner, and our 13-year track record of tenacity and successfully navigating through various market cycles will show in the future. I hope that everyone views our transparency and our openness as a positive. We want to be transparent. We want to be open. And I think it's important, especially in these times, to communicate openly. We plan to have another investor day in the spring to update everyone, and appreciate your patience, your support, and your trust with us. So we're starting to send quarterly distributions next month, and we look forward to sharing a new exciting opportunity in the Stellar Braze in the coming weeks. So just to wrap, a recording of this presentation is going to be shared with our investor network, and don't hesitate to reach out to the investor relations, to Kate, to myself. If you have any questions, the email address is investors@barvin.com, and we look forward to hearing from you. Thank you again for your time, and hope you have a fantastic day.